On Wednesday, the Fed decided to keep the federal funds rate the same and not raise it again, at least for now. Since March 2022, the Fed has raised rates 11 times to go from 0% to the current 5.25 to 5.5% range. And Fed Chair Jerome Powell spoke about the Fed's decisions to keep the main U.S. interest rate unchanged and what they see for the future. And the stock market is trying to figure out what it all means. In this video, we're going to break down some of Jerome Powell's comments, what it might mean for stocks, and what we should be doing about it, if anything. So let's dive right in and get into some of the comments made by Fed Chair Powell on Wednesday, and then we'll talk about it.
Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, we are in a position to proceed carefully in determining the extent of additional policy firming that may be appropriate. Our decisions will be based on our ongoing assessments of the incoming data and the evolving outlook and risks.
So first of all, I just want to say shout out to Apple. Jerome Powell giving Apple some free advertising on the usefulness of iPad. Love that. And basically what he's saying here is that the Fed has acted pretty aggressively over the past 18 months to try to get inflation down. And so now that they've done that, they want to wait and see how the data comes in because they don't think that the full effect of those changes have actually been felt in the economy yet. And so their idea going forward is let's just slow play this, see how the data comes in, and then we'll decide what we're going to do next. And you might wonder, how different is that from things he said in the past? I don't think it's all that different, but I do think the main point to take away, at least for me, is that he expects there to be some lingering effects of the rate hikes that they've already made that we just haven't felt yet. And then Powell goes on to talk about a bunch of economic data that I'm not going to rehash here, but I do think the discussion around the labor market is important because it impacts people's ability to earn an income, pay their bills, and hopefully have enough left over to invest. So let's dig into what he said, and then we'll talk about it.
The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 150,000 jobs per month, a strong pace that is nevertheless well below that seen earlier in the year. The unemployment rate ticked up in August but remains low at 3.8%. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises from 3.8% at the end of this year to 4.1% over the next 2 years.
Now, here's the main points that I think he's trying to get across. The Fed wants to get a 2% inflation. That's their target. And to do that, the economy has to slow down so that inflation comes down, in a nutshell. So when they talk about the labor market, they're talking about it in terms of slowing it down, which is just an uncomfortable conversation because you can't have someone up there saying, oh, we want more people to lose their jobs. It just doesn't work. But that's the context that they're working with. And that's why the verbiage that they use is kind of weird because they're just trying not to say that uncomfortable truth. And Powell's saying that they've seen some improvement with supply and demand balance, but mostly it seems because companies have slowed or stopped hiring. So basically, the number of available jobs is getting smaller. The unemployment rate is currently at 3.8%, and they expect it to be over 4% over the next 2 years or so. So there's going to be more folks losing their job. And Powell mentioned that nominal wage growth has been easing, which basically means that wages are going down and people are getting paid less. Now, to be fair, what Jerome Powell talks about is nominal wage growth with the idea that hopefully real wage growth still goes up. Now let's talk about what the differences are between those two. Your nominal wage is what you get paid, your actual salary. So let's say it's $20 an hour. That's your nominal wage. Real wage is what you earn relative to inflation. So your $20 an hour is worth less when inflation is high, and it's worth more when inflation is lower because your purchasing power increases as inflation goes down. So the idea for the Fed is, yeah, your nominal wage is going down, but we're bringing inflation down. So it should be a net positive for you, and your real wage should still be going up. Now, whether that's true or not, I don't know, but that's the idea. So the main point I think to take away from this is that the Fed thinks the job market is going to continue to slow down over the next 2 years. So as income earners, we need to evaluate the income that we have. Are our jobs stable? Do we have enough income coming in? And what would we do if something happened to that income? And obviously, these are things that we should always think about, but with what's going on in the broader economy and what the Fed expects, it's just a good idea to really make sure that we know what we're doing with our income and that it's as stable as possible. And it's not just the job market, but the Fed's plan just to get inflation down, I think has a longer timeline than people expect. Here's what he said.
The process of getting inflation sustainably down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.3% this year, falls to 2.5% next year, and reaches 2% in 2026.
Now, obviously, these are just projections, but they expect inflation to hit 2.5% next year and then finally get to around 2% in 2026. Now, what that means to me is that the rates that we see are probably going to be around a little bit longer than some people expect. This isn't something that's just going to reverse course early next year unless something unexpected happens. And speaking of the Fed guidance on future rate hikes, this is what Powell had to say.
It's just a question of reaching the right stance. I wouldn't attribute huge importance to one hike in macroeconomic terms. Nonetheless, we need to get to a place where we're confident that we have a stance that will bring inflation down to 2% over time. That's what we need to get to, and we've been moving toward it as we've gotten closer to it. We've slowed the pace at which we've moved. I think that was appropriate. And now that we're getting closer, we have the ability to proceed carefully.
And Powell was also asked about a potential rate cut going into next year, and here was his response.
Yeah, so as we go into next year, that's the question we'll be asking is, taking into account lags and everything else we know about the economy and everything we know about monetary policy. The time will come at some point, and I'm not saying when, that it's appropriate to cut. Part of that may be that real rates are rising because inflation is coming down. Part of it just may be that it'll be all the factors that we see in the economy. And, that time will certainly come at some point. And what you see is us writing down, a year ahead estimates of what that might be. And, there's so much uncertainty around that. When in the moment, we'll do what we think makes sense. No one will look back at this and say, hey, we made a plan. It's not like that at all. These are estimates made a year in advance that are highly uncertain, and that's how it is.
So when you take those two statements together along with the other stuff, I think it's pretty obvious that a rate hike is way more likely than a rate cut, at least in the near future. Because they want to get to 2% inflation. They have a timeline of how and when they'll get there, and it's out to 2026. So at a minimum, I think rates will stay the same for a while. And I don't think anybody should expect a cut in rates anytime soon unless something crazy happens with the data. And to me, the earliest time to even think about a rate cut is probably about a year from now and not anytime sooner. Okay, you're probably wondering, great, but what does it actually mean for stocks? So one of the things that constantly gets talked about is, are we going into recession or is the economy slowing down? And trying to understand what that means for company earnings and eventually stock prices. And we're talking about this even as the S&P 500 is up 15% year to date, so it doesn't seem like these things make sense together. So let's listen to SoFi's Liz Young on her thoughts of where stocks and the economy are going.
So Gundlach would say, who we just obviously talked to, Jeffrey Gundlach would say that's exactly why he thinks that stocks are, in his words, wildly overvalued relative to bonds for the very scenario in which you say elevated rates and economy that's going to come in as a result.
Right. So I think the soft landing expectation is taking what's going on today and extrapolating it out into the future and acting as if nothing's going to change. We're just going to stay on this trajectory. As we know, and as Jeffrey rightfully pointed out, the lags and even yield curve inversions, or what you point to whatever indicator you want, this is the period where it usually starts to be a problem. So declaring victory and saying a soft landing is just going to create a scenario where this all continues, I don't think is likely. It's going to have to inflict pain, and that has been reiterated by the Fed. It's going to have to inflict pain. We've seen a little bit of pain, but not quite enough yet to take care of the inflation problem. I am absolutely with Jeffrey on the idea that I think we'll see cuts before the market thinks we'll see cuts. And I think we're going to see more cuts before then, because I don't think that it's sustainable to expect rates to stay at this level, expect the yield curve to stay this inverted, and that everything else just sort of carries on its merry way.
So in her view, she's saying there's going to be pain around the corner that we haven't felt yet, and it's going to cause the Fed to reverse course and actually cut rates, which in theory makes stocks go up. And this is part of the challenge, because on a day-to-day basis, these things seem to have a big impact, with stocks going down 2-3%, and everyone trying to figure out what's going to happen in the future. But if we actually look at the overall performance of the S&P 500 compared to the interest rates of the time, it's a little less obvious. Because even looking at the years that had really high interest rates, the market still had decent gains. So it doesn't seem to be any obvious correlation between interest rates and stock market performance overall. Now, obviously, there's going to be certain types of stocks that are impacted, which we've talked about before. Here's what I said in my last SCHD video. And the type of dividend stocks that are going to get hit the most by this are the ones that are usually the most attractive to income investors. And that basically includes REITs, or real estate investment trusts, because they usually pay a high dividend, so they're a favorite of income investors. Plus, they usually carry a lot of debt, so they're likely to see profits and expansion opportunities go down, which is a double whammy. And then also utilities and telecom services. Now, these companies usually pay a good, stable dividend, and they tend to use and carry a lot of debt as well. So again, they're favorites of income investors and likely to see impacts to their profitability. And then lastly, high-yielding dividend stocks and dividend aristocrats that are stable but grow slowly. Because again, the stability and high dividend yield are attractive to income-focused investors. And with interest rates likely to be the same or probably a little higher for a prolonged period of time, I think those things will still be true. So while there are certain types of stocks that will be impacted, it doesn't seem to really tell us anything meaningful about the stock market overall. And if that's the case, what should we actually be doing about it? So if you're planning long term and you're not trying to get in and out of positions a bunch, in terms of recession and economy and all that type of stuff, I don't really think you change your approach much, if at all. It's still about finding great companies with great businesses and attaching yourself to them. Regardless of what's happening with prices or rates, that's generally the plan, at least for me. The only thing you might want to do, which we touched on earlier, is spend some time focusing on your income situation. Is it stable? Can you create additional income streams? Are you able to invest or contribute more? Because if the economy is going to be uncertain for a prolonged period of time and there's likely to be more layoffs and higher unemployment, then you want to make sure you have the most important thing taken care of, and that's, are you able to pay the bills each month? Plus, if you're in a situation where your income needs are met and you have that stability, then increasing your income only means that you get to buy more stocks at lower prices and really stack up over the next couple of years or so. Which is why there's really no downside to working on the income side of your finances. One, to make sure that you and your family are good, but then two, to get to your investing goals even faster. So when it comes to the Fed and interest rates and all this stuff, just like everything else, there's a lot of talk, a lot of articles, a lot of videos like this one. But how we should handle it really remains the same if you're a long-term investor. 1, increase our income. 2, find great companies to invest in. And then 3, hold those companies over the long term. And rinse and repeat. And those 3 things are things that are important in any environment, not just the one that we're in now. Because ultimately, the things outside of our control, like interest rates and the economy, are going to have way less impact on our success than focusing on those 3 things that are within our control. So what do you guys think about the Fed's decision? Are you worried about it as a stock investor, or is it just another news day and you're working your plan? Let me know down in the comments below. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace.